Good morning, everyone. Thank you for joining us for our latest advisor webinar, where we're going to be talking to what's happening in the bond market. My name is Adam O'Connor. I'm a director here at BetaShares, responsible for advisor and broker relationships. And leading the discussion today, I'm joined by Chamath De Silva. Chamath is a senior portfolio manager here at BetaShares, responsible specifically for the fixed income side of our business. So that includes product development and overseeing portfolio management of our fixed income ETFs. Prior to joining us here at BetaShares, Chamath spent 7 years at the RBA, where he's managing their FX reserves across a variety of global bond markets, and so I can fairly comfortably say he's extremely well placed to talk to the topics we're going to cover this morning. Before I do kick off, I do have to highlight that the information we're presenting here is for financial advisors only, and is not to be distributed to retail clients. And of course, the information is general in nature. It's also worth highlighting that a copy of the presentation will be available and sent out following today's webinar, along with your CPD for attending. So just as a brief overview of BetaShares for those of you that are maybe joining us for the first time, we are a specialist ETF provider. We now have 71 ETFs listed on the ASX, or exchange traded products. That is the widest range of any Australian provider or ETF manager. And we now have over 22 billion in assets under management. In terms of today's agenda, this isn't designed to be an intro to fixed income, but rather a conversation around the current state of the bond market. So in particular, we'll be talking to how bond markets have reacted to inflation pressures and tightening central bank policy settings, what markets are pricing in, and implications for portfolio positioning. We'll also close by providing an overview of our fixed income suite and an introduction to our latest offering, the BetaShares Australian Composite Bond ETF. We will have time for questions, so please feel free to ask any questions you have in the chat box as we go, and we'll come to those at the end. And with that, I'll pass over to you, Cham, and we can get straight into it.
Thanks, Adam. Well, it's been a tumultuous past few months for fixed income globally, with benchmark indices such as the Bloomberg OZBD Composite and the Bloomberg Global Aggregate incurring historically large drawdowns, as seen in this chart. Now, the main driver has been markets trying to digest a much more aggressive rate hiking outlook as central banks globally look to curb inflation pressures and anchor medium-term inflation expectations. And now this leads us to current market pricing. For the RBA, futures are implying 8 hikes for the remainder of this year and 11 hikes over the next 12 months. And for the Fed, the market is now pricing in 9 additional hikes for 2022 and 10 additional hikes over the next 12 months. Now, current market pricing is important, and if there's one takeaway from this webinar, it's that what matters for bonds isn't rates rising per se, but rates rising more aggressively than what's already priced into the yield curve. And right now, we have a very aggressive rate hiking cycle already priced in. Now, rate hike expectations are aggressive, but it's interesting that Australia has some of the most hawkish rate hike pricing, despite a relatively benign inflationary backdrop, at least compared to the US or Europe. Now, the chart on the left shows swap implied rate hikes over the next 1 year and 2 years, while the chart on the right shows trailing 1-year headline CPI and 1-year forward CPI as implied by the inflation swap market. Now, this results in Australia being an outlier among developed markets in not only offering positive real yields across most tenors now, but also positive real policy rate expectations over the medium term. And staying on the topic of market implied rate expectations, this chart shows what the yield curve is implying for forward interest rates over the next 1, 2, and 3 years. Now, we can see that the market appears to be converging on a rate hike cycle ending somewhere between 3% and 3.5%. Now, if rate hike pricing or if market pricing is accurate, it would be the most aggressive hiking cycle in the inflation targeting era over a 2 to 3 year period. So in addition, the current rate hike pricing is also comparable to the most aggressive historical rate hike pricing over the past 30 years. And you have to go back to the early 90s to see similar levels of hawkishness from the market. Now, this is a chart showing bank bill futures implied rate changes over 1 year and 2 years ahead. And the reason I show this chart is twofold. First, the market has historically tended to overestimate rate hike pricing relative to what's ultimately delivered. And second, peaks in rate hike pricing have historically provided the ideal entry point for duration and fixed rate exposures for investors with a medium-term horizon. And this comes back to my earlier point about what matters for bonds is what's delivered relative to what's priced in. Now, this table you can see on the screen shows the peaks in the 2-year rate hike pricing from the previous chart. And we also look at these episodes and assess the forward 2-year returns on cash, 5 to 10-year government bonds, and 5 to 10-year investment grade corporate bonds with the actual cash rate moves shown for reference. As you can see, all these episodes provided significant excess returns for bonds over cash, regardless of whether the RBA actually hiked rates or not. The key was that rate hikes fell short of what was priced in. So if you believe that rate hike pricing over the medium term has likely peaked, then it's worth considering fixed rate bonds right now. So that leads us to the question of what to do. So if you think that rate hike pricing is overly aggressive, then consider extending duration or increasing exposure to fixed rate bonds or fixed rate bond exposures, including ETFs such as AGVT, CRED, or OZBD. On the other hand, if you think the RBA will be even more aggressive than what's already priced in, then it's worth allocating to floating rate exposures, which will benefit from higher income from the rise in the benchmark 3-month BBSW rate. And such ETF exposures include coupon, Bhyb, and Hbrd. Now, the BetaShares house view is that the RBA may struggle to deliver the rate hikes that are currently priced in, which leads us to be fairly constructive towards Australian fixed rate bonds, both on an outright basis and relative to global fixed income. And I'll just add that the sell-off we've seen in Australian bonds hasn't just been limited to traditional government securities, but it's also impacted inflation-linked bonds. And in addition, we've seen wider credit spreads on investment-grade corporate bonds. So if you are still constructive on credit, it might be worth considering longer-dated fixed-rate corporate bonds, given both the yield curve and the wider credit spread together provide a sizable buffer against rising rates. Now, on the other hand, if you are concerned about rising recession risk globally and the risk that credit spreads will continue to widen, then it might be best to play the moderation in rate hike expectations, if that is your view, via high-grade bonds such as government bonds primarily. Now, this leads us to our fixed income suite and our new fund, OZBD. Our philosophy around fixed income product development has historically been around producing low-cost, efficient duration and credit building blocks to help empower asset allocators and investors more generally to take more control over their fixed income exposures. Fixed income isn't one size fits all, and each investor will need something different out of it, whether it's income, whether it's capital stability, equity diversification, or some combination. However, it's also clear to us that many investors are benchmark aware and are sensitive to tracking error against the Ausbond Composite. And this was our motivation for partnering up with Bloomberg to launch an ETF of their new yield optimized composite bond index. So OZBD is a core portfolio allocation and aims to track the Bloomberg Australian Enhanced Yield Composite Bond Index. The objective of this index is to improve the parent's yield while maintaining similar characteristics. So why is it possible to improve on the AusBond composite? So liability weighting in fixed income benchmarks creates several flaws, as many of you would be aware. And this is mostly around duration and segment creep, which you can clearly see from this chart of the historical composition of the AusBond composite index. But ultimately, in such indices, issuers can effectively set their own weight, meaning it's issuance patterns and not investor needs that determine the nature of the exposure. And right now, Commonwealth and state government bonds account for over 80% of the AusBond composite, making it less of a composite bond exposure and more like a standard government bond index. And as a result, it is possible to significantly improve on the outcomes without a significant deterioration in credit quality or liquidity. And we felt Bloomberg was the index provider best placed to improve on their own benchmark. I might just quickly run through how the index works. And OZBD's index involves what's known as a constrained optimization process. So Bloomberg breaks up the parent index into 8 sub-indices, specifically government and non-government sectors across 4 maturity buckets: 1 to 5 years, 5 to 7 years, 7 to 10 years, and 10 years and greater. Bloomberg's optimizer then reweights the sub-indices to maximize the yield to worst, which is the objective of this index, subject to constraints around tracking error, a maximum duration overall underweight of 1 year relative to the parent index, a minimum allocation to government bonds, a minimum weight to each sub-index of 5%, and finally a turnover constraint to mitigate the risk of excessive churn, with the portfolio rebalanced monthly. It's also worth emphasizing that the optimizer reweights at the sector and maturity bucket level and not at the security or issuer level. Right now, OZBD's index yield offers a pickup of around 80 basis points above the AusBond composite. And this is coming from a +1 year increase in duration, which is a maximum duration overweight, and a half ratings notch downshift in credit from AA+ to AA, but still a very high credit quality overall. Naturally, there is an overweight position in corporate bonds as well as supranational and agency securities, and an underweight position in government bonds. However, we argue this provides a much more balanced fixed income exposure and a truer composite exposure. And it's worth emphasizing that the credit quality is still very high at AA overall. So in addition to sector positioning, the optimizer will take curve positions to enhance the yield. And currently there is an overweight in the belly of the curve, that is the 5 to 10 year segment, with an underweight in the front end and the very long end of the curve. Bloomberg has produced a backtest of OZBD's index, and over the past 10 years, including the historically large drawdown the past 12 months and the historically large underperformance the past 12 months, the index has still managed to return around 53 basis points per annum in excess of the AusBond composite, with the majority of this excess return attributable to excess yield and curve roll down. Now, the underperformance the past 12 months is notable, but it's worth remembering we've had the double whammy of the combination of an aggressive repricing higher across the benchmark yield curve, in addition to wider credit spreads. But the flip side of this is a much higher yield pickup than what was experienced historically. Now, over the past 10 years, the yield pickup over the AusBond Composite has averaged around 35 basis points, but this is now blown out to 80 basis points currently. And given the yield pickup has been the largest driver of forward excess returns over the AusBond Composite, we'd argue that it bodes well for the index going forward. And what's on screen right now is just the latest fact sheet showing the current sector allocation as well as the index credit quality. And with that, I'll hand it back to Adam.
Thank you, Cham. So I guess just to summarise OZBD in simple terms, we'd describe OZBD as a more balanced core bond exposure and more of a true composite bond exposure, just given how unbalanced and heavily skewed towards government bonds the traditional AusBond Composite has become over recent years. And what we're doing in terms of a process is actually quite similar to what an active manager might do and what most of them actually do by systematically taking on sector positions versus the benchmark, rather than necessarily at security level, and obviously at a much lower management fee of 19 bips. And ultimately, for us, we feel this improves outcomes for investors without necessarily undermining the defensive characteristics that we do want out of our fixed income portfolio. So look, before we move on to some questions, which we do have and we've got time for, we have here the latest yields across all of our Australian fixed income exposures. And here I just wanted to highlight this. This is what we call our fixed income term sheet. We can provide this on request basically at any time, and it includes all the key details and metrics across our fixed income suite, including expected total return and as well as the roll yield, which is somewhat of an underappreciated additional source of return for many of our funds. And it's something that a lot of active managers benefit from in their portfolios. And that's when we rebalance the portfolio. We pick up that additional source of yield, and it's something that you actually miss out on in many of the traditional fixed income indices that a lot of ETFs track that hold to maturity. And so with that, I might just move on to a couple of questions, Cham. We can have a bit of a conversation around some of the things we covered. The first one I wanted to ask, which we've had submitted, is okay, how far do we see the official cash rate getting to? I guess what's our house view on rates?
So I personally don't have a level myself, but I guess our chief economist, David Bassanese, who's thought a lot about this, his view has been, the RBA would struggle to hike beyond 2%. And it's worth remembering that market pricing is indicating somewhere between 3 and 3.5% is a level that the cash rate will end up. Now, while I don't necessarily have a view on what level will be reached, I must acknowledge that there are certain limitations on how fast the RBA can hike. We have quite an indebted household sector by global standards, and we also have we have a household sector that's also very sensitive to short-term interest rates. Now, the vast majority of household debt outstanding is benchmarked to floating rate, with a fixed rate debt, still limited to very short tenors such as 2 and 3 years. And we will see a large amount of fixed rate resets during the next 12 to 18 months. And that makes, I guess, Australia a bit more sensitive to what the central bank does, at least compared to the US, where they have the luxury of having 30-year fixed rate mortgages, which makes American households a little bit less sensitive to what the Fed does with the Fed funds rate.
And the next one that we've been asked is, what then happens if we get a recession in the next 2 years?
Yeah, well, I would say that a recession would probably short circuit any rate hike plans that the central banks have. Now, one of the consequences of recessions tends to be not only an increase in unemployment, a drop in economic activity, but also a rolling over of inflation expectations, generally as credit drives up and credit growth tends to go in reverse sharply. So if you do start to see recession risks becoming larger or even imminent, that will definitely end any rate hiking plans in my view. And you are starting to see globally recession risk rising a bit. I know the longer ends of yield curves in many countries are already inverting or flirting with inversion, and that has tended to be a bit of a leading indicator for recessions. And it basically is the bond market saying that central banks, while they might have to curb current inflation pressures and anchor medium-term inflation expectations through an aggressive hiking cycle, the duration of such a hiking cycle would be limited from the the demand destruction it would create.
And so what are the asset allocation implications then for inversion?
Yeah, I guess inversion, if we're starting to see inversion throughout more and more tenors in the yield curve, that's basically the bond market saying the central banks made a mistake, or either they've made a mistake or they're going to be too successful in slowing demand. And we've got to remember that monetary policy is a pretty blunt instrument. So regardless of what is causing higher inflation pressures and higher inflation expectations, the solution from the central bank's point of view is to crush aggregate demand. And what that means is that if they are successful, then you'll see a rollover in both growth and inflation expectations, which would actually be, somewhat counterintuitively conducive for, longer term government bonds. Because remember, bonds are forward looking. They price in the rate hiking cycle well before it actually happens. And once the rate hiking cycle actually happens, they'll look through to the consequences of that rate hiking cycle and what comes out at the other end.
Might actually be worth, while we're talking about that, you covered it before, but it's worth highlighting again, previous hiking cycles and what happened to bonds there, maybe 2009.
Yeah, so in 2009, and we can possibly bring this up on the screen. So in 2009, coming out of the GFC, we had obviously quite an aggressive hiking cycle priced in on the post-GFC rebound, and the market priced in close to 300 basis points of rate hikes over the following 2 years. Now, as we'll remember, the RBA did actually hike rates, during that period throughout 2010, but they only managed 175 basis points of hike. So while that might sound like an aggressive move, it still fell well short of market pricing in the middle of 2009. And as a result, the bond market had to recalibrate, medium-term and longer-term rate expectations. And as a result, that drove a big fall in longer-term bond yields. And as you can see from the second last row, government bonds returned 8.8% per annum over the 2 years following the peak in rate hike pricing, and investment-grade corporate bonds returned 13.5% per annum, and both were well above the return on cash during that period.
Going to sort of try and stay on the same tangent here, which is a question of how much further do we think long bond prices can fall?
Yeah, so I guess another way of asking that question is how much higher can long-term bond yields rise? And look, it's a good question. I think, towards the end of Q1, we started seeing flattening pressures globally, and we obviously saw the US yield curve invert, and you started to see outperformance at the very long end of the curve. That's sort of become unwound a little bit as the Fed is now starting to jawbone more aggressively in terms of their balance sheet runoff, and that's created, in my view, a bit of an additional steepening impulse. But at the end of the day, long-term bond yields still reflect long-term growth and inflation expectations, and they reflect, the market's pricing of the terminal policy rate from whatever central bank we're talking about. So, in the US, the 30-year Treasury yield or even the 10-year Treasury yield will, largely reflect, the market's pricing of the terminal Fed funds rate, and conversely, in Australia, the 10 to 30-year part of the curve will reflect the market's pricing of the RBA's terminal cash rate. And generally speaking, if we expect growth in inflation to slow down, then we should expect the market's pricing of that terminal policy rate to also fall. So coming back to the question of how much higher can long-term yields go, it depends on where you think the economy is going to go. If you think that the economy can withstand this initial round of rate hikes, then that will probably force a repricing higher of terminal bond yields. So the onus is now on the economy, both the Australian economy and the US economy, to prove that it can withstand this first round of rate hikes, which would then trigger a further repricing at the back end of the yield curve.
We're going to go back to our view on rates. What speed, the question is, what speed do you feel the RBA will increase rates? Example, are we looking at 250 bip hikes or 425 bip hikes, as an example, over the next 12 months?
Well, we should remember that the RBA's language has been very dovish up until this point, especially compared to central bank peers, and even compared to, I guess, our neighbours in New Zealand. The RBA has only just, publicly entertained the idea of rate hikes this year, because remember, they were pretty stubborn with their forward guidance for a while, arguing that they'll stay on hold until 2024. They relaxed that to 2023, and then they said 2022 hikes would be plausible. I think the recent statement did open the door to hikes, at least in the middle of the year, with June probably the first in-play meeting. So I think the RBA is just looking to get the Q1 CPI and the Q1 wages data out of the way, and it will update its forecasts in May, and then that opens the door to a hike in June. That said, the RBA is still very cautious in its language, just given that we haven't yet seen the wages data hit the RBA's, quote unquote target of 3%. And that level is consistent with what the RBA believes is underlying inflation pressures threatening the upper end of its 2 to 3% band.
I'm going to flip to the other side of the coin. So for people that don't necessarily agree with maybe your view, our house view, and feel the RBA is going to be forced to be maybe more aggressive than what's being priced in, what do they do, and what's the asset allocation implications for them?
Yeah, so I think the asset allocation implications are, if you do believe the RBA will be more aggressive than what's priced in, then probably remain underweight duration, focus on floating rate exposures, and then the question comes in how much credit do you take on within the floating rate segment. So if you are still, I guess, of a risk on mindset, or if you're still broadly constructive on credit, then higher yielding, floating rate exposures such as hybrids might be worth considering. Hybrids have actually fared pretty well so far, despite some of the broader headwinds. And at least across our two funds, we're still seeing very strong inflows. That said, if you are of a more defensive mindset and you are starting to worry more about, I guess, growing recession risks, but you're still not willing to take the plunge into fixed rate government bonds, then high quality senior bank floating rate notes might be worth considering. Or if you're extremely bearish, then all the way to cash.
Nice organic segue to this one that we've been asked is, what's the difference between Bhyb and Hbrd?
Yeah, so at the first level, one is active, that is Hbrd, and that's managed by Coolabah Capital, and Bhyb is an index tracking ETF. So it's an active versus passive. That's the top level, I guess, distinction between the two. And we felt that it was important to give investors the choice between active and passive. Many investors are happy to outsource, the management of hybrids to a well-known active manager who can roam the entire capital structure, that can go underweight hybrid securities when warranted, and that can move across the capital structure from hybrids to sub-debt to senior debt all the way to cash. Whereas other investors, they want a fully invested hybrid exposure. They want to focus on the listed hybrid segment. And for many investors, it's all about selecting just an implementation vehicle to make the process of managing a hybrid portfolio just easier operationally. We know that managing individual hybrids can be quite onerous, and for that reason, many investors have gravitated towards the lower cost Bhyb just as a solution to that problem. So one is active, one is passive. Bhyb is cheaper at 35 basis points versus Hbrd's 55 basis points. Also, some other differences, Bhyb is fully invested in Big Four listed hybrid securities. Hbrd has a broader mandate. It can roam the capital structure. Hbrd will generally have a modest allocation to cash at all times, whereas Bhyb will be fully invested. And I guess the final distinction is Hbrd can participate in primary market issuance, whereas Bhyb will be focused on, I guess, benchmark replication and thus transacting in the secondary market.
Good summary, and I think that wraps it up for questions from the audience. I guess just to close up today's presentation in terms of what we had to cover, I would just highlight quickly from our end in terms of our capabilities and advisor services offering. We do have an analytics team internally. If you would like any portfolio analysis comparing any of the fixed income funds that we covered today, or a mix of those funds to other managers, or see how your portfolio would look by adding or substituting any of our funds, please reach out to your account manager. And with that, we'll wrap it up for the morning.